Okay. Hi, welcome everyone. My name is Marco. I'm a previous trustee of Rethinking Economics. Was part of the kind of founding students that started the movement back in 2013. And I now work at the Bank of England, the financial stability area, but I won't be representing the bank. I'll just speak as a rethinker. And I just want to welcome you to the Rethinking Economics Festival. For those for whom it's the first session, I know others might have gone to other sessions. The festival is a huge 4-day thing with 30 sessions, really looking at a broad range of topics, and I encourage you to look at other sessions as well. So just for a quick background on Rethinking Economics, it's a student movement that was created to improve the teaching of economics, to make it more open to pluralism, more relevant to the real world, and ensure that it includes everyone. And every year we do a conference, and this year, thanks to COVID, we're able to do an online festival and to have as many as 5,000 people that have signed up to this festival. We're very excited to have all of you here. And in this festival, we really want to address kind of the crises that have come up and kind of that COVID has highlighted in terms of racial, gender, economic disparities, but also the climate crisis, and all of these crises are coming together today, and economics being this big tool that can be useful to address them. And so we want to really harness the power of pluralism and diversity in economics to be able to address these issues. So this session was put together by the Rethinking Economics Malta group, which was started a few months ago, and they already got very involved and were able to just to organize this session. And it's about two main things, two very broad themes. The first one is about the current banking system and how we can make it work for the common good and to address the crisis I just mentioned. And the second one is how we can reform the economics curriculum to better reflect the banking system's role and to address this need for reform. And I'm joined today by three really great speakers to discuss these two very broad and ambitious topics. The first one is Josh Ryan Collins, who's head of research at UCL's Institute for Innovation and Public Purpose. He has published extensively on monetary policy, credit, land and asset prices, and the role of central banks in supporting a low carbon transition. Our second speaker is Fran Boyd, who is executive director of Positive Money, which is an organization that campaigns for systemic change of the money and banking system to support a fair, sustainable, and democratic economy. And she's now leading the international expansion of the movement. And our third speaker is Dr. Carolyn Sissoko, who's an economist and lawyer who has published widely in the fields of banking, financial regulation, and their history. She's currently a senior lecturer in economics at the University of the West of England, and she blogs at Synthetic Assets. So just a little bit of housekeeping. We'll spend the first 45 minutes of the discussion discussing our first topic around the issues with the current banking system, and we'll then move on to our second topic around economics education. I think all of the participants are currently muted, and you can't really unmute yourself, but you'll have plenty of opportunities to ask questions in the Q&A box, which you'll find at the bottom of your Zoom screen, and you can even vote up and down questions that you like or dislike, and we'll then kind of select some that we'll take. If some questions are, we might also ask you to kind of be unmuted and ask your questions verbally. We're also on Facebook Live, so you can rewatch this, and we'll put all the sessions on the Rethinking Economics website as well. So let's start on the banking system. So as we said, kind of after the crisis, there was lots of reform for kind of more capital, more safety in the banking system, but now feels like the challenges with the banking system are a bit different, and about kind of harnessing how we can have kind of productive finance and make sure that banking kind of lends to a productive economy rather than gambling or buying and selling existing property assets. And also in COVID, we've seen that banks have lent a lot to businesses, but now businesses are very indebted, and this is going to be a big issue for the recovery. And finally, after COVID, all the other problems of the world haven't stopped, and the big one of climate change remains. And so addressing these issues of a banking system that kind of that funds productive investments, that doesn't lead to having too much debt, and that addresses the climate crisis are big issues that we can discuss today. And so our first question to our panelists would be about kind of how the banking system can change to respond to these challenges and serve the common good. And we'll start with 10 minutes, more or less, for each speaker. And we'll start with Josh on that, if that works.
Thanks very much, Marco, and thanks to everyone who's tuned in for this session. Great to be here alongside Carolyn and Fran. I thought I would just talk a little bit about the current banking system in advanced economies, which is my specialist expertise, but there's some similar dynamics in emerging markets as well happening. So I've just got a couple of sort of slides that I wanted to share, but I think that the key point, sort of takeaway point I wanted to make really was that although there have been, as Marco said, many good reforms to the banking system post 2007, 2008, particularly banks now hold more capital and they are more resilient to shocks at an individual level, especially some of the larger ones. We've obviously not seen the level of financial chaos that we saw in 2008. Partially also because central banks have intervened very, very quickly and more effectively than they did in 2008, I think. But we've still got a sort of fundamental problem, not so much around banks' individual sort of resilience, but around the system itself, or the financial system itself, and the role of the financial system in allocating credit into different parts of the economy. So credit allocation really is the problem that has still not been addressed. Now there's been a recognition since the crisis, and thanks to the work of organisations like Positive Money and many others, that there's been a recognition by central banks that banks do create money, and that credit and money creation process is macroeconomically very important. But there's been less recognition of the fact that banks allocate credit in the process of creating it to different parts of the economy, and those have different effects, macroeconomic effects. And of course, as Marco mentioned, they can also affect the sustainability of the economy, the ecological viability and sustainability of the economy over time. So I think that's what I just want to focus on in this first initial 10 minutes. I'm just going to share my screen with you. I can make this work to get these slides up. Okay. Right. So the key point I just wanted to make initially was, I guess I need to take off all of this Zoom stuff in order you can see this slide properly.
We can see well.
Okay, you don't have these bubbles, no. All right. So essentially the key point is there's two circuits for bank credit in the economy. This first circuit is the one that the textbooks tend to talk about, that bank credit flows from savers into businesses. It's invested in working capital investment. It increases GDP transactions. It leads to growth, increased wages, consumption. It supports a productive investment essentially in the economy. And you get this sort of positive circle. Obviously, some loans default, businesses don't do well. You have a business cycle, quite a rapid business cycle. But that's the sort of classical presentation of the banking system. But what we saw in the lead up to the financial crisis, and what we've seen more generally, is that there's this second circuit where banks lend against existing assets. So real estate is the one that's received most attention. Banks lending to support the purchase of existing property and land rather than actually funding new construction of buildings. It just enables people to compete with each other with more money to buy a finite set of housing essentially. And this leads to asset market inflation. And it can actually lead to a stagnation in wages and productive investment as people's debt rises relative to their incomes. And there's not been enough attention for me to these two different circuits and potential role of central banks and regulators in steering credit in one direction or another. This chart just shows for sort of averaged across 17 advanced economies, the growth in total credit relative to GDP. This is bank lending. On the left-hand axis, the non-dotted line, the black line, you can see there's been a massive expansion in credit, particularly since the mid-1990s. But you see on the right-hand axis, the dotted line, the share of that lending flowing to non-financial firms, excluding real estate, excluding the financial sector, has been falling considerably, from around 90% in 1980 down to just over 60% today. Now, that is a major macroeconomic shift in the role of the banking system for the reasons I just explained in the previous graph. The predominant role of banks now is to lend against existing assets, not to fund productive investment. If you look at the UK case, we're one of the worst examples of this. You could see the fall in lending to non-financial firms. The blue bar at the bottom has fallen from around 35% of the total, this is, to under 10%. So less than 1 in every £10 of loans made by domestic UK banks is actually supporting the classical role of banks in supporting non-financial firms, whilst there's been this huge growth in mortgage credit, quite a big growth in commercial mortgages, commercial real estate, and also significant growth in lending to other parts of the financial sector, much of which is described as socially useless by Adair Turner, sort of lending to asset managers or hedge funds or other firms simply to enable financial trading, buying up other financial assets, etc. And Carolyn's done some work on this, which I'm sure she can talk about. My work has focused more on the impact of this shift in lending on house prices, and my sort of book that I've written recently on this argues that actually increased lending against property is the main driver of rising house prices since the 1990s. This chart just tracks mortgage credit outstanding against real house prices on the right hand side, going right back to 1870, and you can see the not much correlation between the two series up until the 1990s, when you get this huge sort of exponential increase in mortgage credit at the same time as house prices shoot right up. So for me, it creates a fundamental social problem that people can no longer afford to buy homes, that you've had this growth in mortgage credit. The other big issue though is climate change and ecological sustainability, and what we've seen there really, I think, is central banks embracing that they do need to address lending against environmentally unsustainable activities as part of their remits, because of the financial stability implications of stranded assets and lending leading to a collapse in the value of firms, with knock-on effects on the financial sector. But an emphasis very much on the idea that the cause of this is a lack of information in the market, preventing effective and efficient price discovery. So the idea is, if firms disclose their exposures to fossil fuel intensive firms, if banks disclose their exposures, the market will adjust the price of or the interest rate on certain loans, or the price of shares will adjust naturally. There's very little evidence of this happen, so the task force on climate related disclosures has not led to a big shift away from lending against unsustainable forms of assets. So I think we've been working on more concrete interventions, whether it's raising capital requirements or simply excluding certain categories of lending completely because they're so clearly unsustainable, such as lending to enable new forms of fossil fuel extraction. And we think we're making some progress here, but I think there's much further to go. But just on the credit allocation point, I think the policies we would be pushing would be to return to the whole idea of credit guidance, this idea that central banks and supervisors working together with governments, industrial policy, should actually be steering credit into those sectors of the economy where we most need it to support a Green New Deal or a low carbon transition. And it's just not sufficient to leave it to the market, in this case, the financial market and the banking system, that will not lead to an optimal allocation of credit. And I'll leave it at that. Thanks.
Great. Thanks, Josh. Hopefully this message will be heard widely. Let's move on. And Carolyn, do you want to go next?
Hello. Well, thank you very much for inviting me to be here and talk about one of my favorite topics. Since, we want to get into the issue of education as well, and I actually believe that a lot of the problems we face in our current financial system come from problems with the frameworks of how we understand what banking is. I'm going to try and really quickly run through in 10 minutes kind of a basic framework for understanding banking. The problem with the market-based lending, which has kind of been the fad since the 1980s, is, markets can provide loans just as well as banks, so we need to have a growth of market-based lending. What the theoretic problem is with that, and then kind of how we got here. It's going to be really, I'm going to buzz through a lot of points. How we got to where we are, and then what that implies for what we should be doing. So I'm going to buzz through a whole bunch of points. I've got it in outline form, so I'm going to present, I'm going to give you the points as I go along. And let's see. Okay, share. Okay, so I'm just going to buzz through some basics of thinking about banking. And I think one of the first principles is that banks are not intermediaries, but there are two key issues that make them not intermediaries. First of all, they actually bear the risk of the loans that they hold. What this means is that if a bank holds a loan on its balance sheet and that loan goes into default, who bears the loss? The shareholders of the bank. The bank itself bears the loss. It's going to come out of bank capital. From an economics point of view, we immediately say, well, that means the bank has incentives to make good loans. If the bank makes a bad loan, it's going to lose money because it's going to come out of its capital. So that's an advantage of banks lending on balance sheet. And you can compare this to an investment fund where you have people who put money into a fund that then invests in assets. And when that investment fund's investments go bad, they don't go to the losses don't go to the managers of the investment fund. They get passed back to the investors in the investment fund. So it's a pass-through thing. It's different from a bank. They're true intermediaries. They don't bear the risk of the loans that they hold. Investment funds just pass it on to the investors. And this means that investment funds have an other people's money problem that our traditional banks didn't have. We'll get into how the banks have changed in a minute. Then the other key thing about banks not being intermediaries is that they expand the money supply when they lend, because their deposits are also means of payment. This has really good effects for the economy in an environment with growing GDP, because we need our money supply to grow alongside GDP growth. And this is right along the lines of what Josh was saying. Hey, when banks are investing in productive activities, you have this promotion of GDP, of economic activity. High quality loans are really good when banks are making them and when banks support and direct that money growth. But banks have another side because they expand the money supply when they lend. If it's not carefully managed, if loans are made carelessly or fraudulently, I should have added if loans are made against things like real estate, which is what Josh was pointing out, they can easily cause inflation, instability, and essentially bank lending and asset price bubbles. That's implicit in what we think of when we think of banks playing a role in the money supply. Now, so basically, I'd say from a basic framework for banking, there are some implications. Banks play a role in economic growth when they fund good loans. bank regulation and the way that bank created money flows in the economy is one of the key determinants of economic growth. Now, Josh was basically making this point. If they're doing productive investment, banks are amazing. It's cool. We like our financial system when it does productive investment because it really fosters economic activity. But they can do other things. Asset price bubbles are evidence that we're not regulating our banks correctly. So when we see things like this real estate bubble, the first thing you should say is we've really got to do a huge reform of our banking system because it's evidence of a problem. And another key thing is that investment funds can't provide the same services as on-balance sheet banking. It's the basic analysis of incentives. The incentives for an investment fund do not encourage them to make the same quality of loans as the incentives for a bank. So those are kind of the key principles I tend to start with when I think about banking. And then we bring it to what's been going on lately. Since the 1980s, there's been a fad for market-based lending, and there are two assumptions underlying that market-based lending. First is that investment funds are actually a substitute for bank lending. There's a missing thing in this theory. From a macro or systemic point of view, they have weaker incentives than on-balance sheet bank lending. I mean, this is something that should have been taken into account from the beginning, and it wasn't. And there's another key assumption to this fad for market-based lending is that markets are a source of liquidity. They're ignoring Keynes' point that there's no such thing of liquidity of investment for the community as a whole. What this essentially says is when you're in a point where everybody is invested, even if it's 30-year treasuries, if everybody happens to need cash at the same time and tries to sell those treasuries at the same time, the market isn't going to solve that problem, right? When people need cash, the market does not solve the problem. Market liquidity has a tendency to evaporate when it's most needed. That was a really basic point made by Keynes. It should be considered a basic principle of economics, but if you think about it, our most standard model in economics completely ignores this. And unfortunately, it's actually affected bank regulation itself. Okay. So the implications of this move to market-based lending are, first of all, that the quality of lending has declined because we have so much of this investment fund financed lending that doesn't have the right incentive structure. We can see that it's a disaster for borrowers because we have lots of problems, whether it's the developing countries with unsustainable debt or whether it's lower income individuals in the US or the UK, they end up trapped in unsustainable debt. It's a disaster for them because it's not the right kind of lending. It's actually a disaster for traditional banks, and it really changed the banking system. We don't really have many traditional banks because they were forced to compete against unregulated low quality lenders, and that made them end up joining them and making bad loans. And there are two key things that happened, and one is off-balance sheet lending. And this is essentially how banks finance what's called shadow banking. They start financing the low-quality lenders, but in a way that the losses, at least in theory, don't come back to them. On the books, they don't come back to them. They have this theory that somebody else should pick them up, but then, as we have seen in a variety of crises, somehow they do, and they get bailouts. The other big thing that happened is the growth of repo lending. This is collateralized lending when you borrow against things like government debt. What's happened since 2008 is that because there's such a big problem of bad debt, the banks actually don't trust each other anymore, and they lend to each other on a collateralized basis. This problem of lack of trust at the heart of the banking system, I would argue, is a huge issue that has been created by the growth of market-based lending and low-quality loans. It hasn't been a disaster for lenders because the government keeps bailing them out. The biggest banks are doing fine. Smaller banks end up getting closed down, but the biggest banks get bailed out. And so it's actually kind of, we've created this really weird system. A few other points that have come from the shift to market-based lending. Asset price bubbles have become the norm. This was what Josh has been talking about, giving you a whole bunch of data about it. I'd say it makes it crystal clear bank lending isn't being regulated appropriately, or we would not have this huge problem of asset price bubbles all the time. We also have this problem that financial markets keep freezing up. They froze up in 2008. They froze up in March. I would argue that this, as Keynes pointed out, is the nature of financial markets. You can't expect financial markets to be a source of liquidity in troubled times. And people who are working from a theory that they are just creating problems for us that's getting thrown into the hands of the central banks. That's why the Fed had to step in like crazy in March, is because of these bad assumptions. And it's just, I think everybody is kind of doubting right now whether the path that we're on is sustainable. And here's my last slide. So we're asking, what should we do? So in my view, the fundamental source of liquidity that made possible modern economic growth starting around 1800 was trust in the banking system. Low quality lending has destroyed that trust. It's harming us all because it's based on loans that trap borrowers in a cycle of poverty. And all we've got left in the modern system is trust in a few governments or central banks, which is unsustainable. So what do we need to do? And I probably should have added a few more points here, but one of the key things is transition away from these collateralized interbank lending markets that rely on market liquidity and that when markets freeze up, throw us into the hands of the central bank. We need to close down shadow banking by putting an end to banks providing off-balance sheet guarantees. Bank lending should be on balance sheet. And I think I would add a third point that comes right out of Josh is we need regulation that keeps banks from lending against things like real estate and creating asset price levels. Okay, I'm gonna turn off my sharing and pass it over to Fred. Thanks.
Great, can you hear me? Okay, really nice to be here. Thanks for inviting me, Marco, and hope the rest of the Rethinking Festival is great. So I'm Fran, as mentioned. I run an organization called Positive Money. We're a civil society organization that was set up a direct result from the crash, and we work on reforming money and banking for a sustainable, fair and democratic economy. Which, as Josh and Carolyn have alluded to, is quite challenging. So I'm gonna just talk, kind of focus on the UK, and hopefully build on what the other speakers have said. So, as you've heard, I'm sure you're aware, banks have this enormous power to shape the economy and, affect everything from job creation to levels of inequality and poverty, and they have this large power to create the money by lending, and yet they're not really held to account, which we saw quite clearly in the crash, but also since then the response hasn't been kind of the magnitude to kind of match the scale of their power. And we saw in the run up to the crash, as we've heard about, lending and money pouring into asset bubbles, essentially property and financial markets, inflating asset prices, driving increasing private debt levels. Eventually the kind of boom became unstable and the debt mountain too large and the crash happened. And in the UK, we had at that time, and we still do to an extent, a very concentrated banking sector. So 5 big banks occupied 85% of the market in 2008, and that means that any one of them was too big to fail if the government or central bank had let them go under. They would have also brought our payment system down and effectively ground the economy to a halt. So obviously, as we saw, many bailouts happened in an attempt to hold the banking system, but what has really happened, I guess, in the last 12 years hasn't been enough. So I guess there's kind of 2 things that we would have been hoping would have happened. So a redesign of the system, things like taking out moral hazard and too big to fail, and some of the things that Josh and Carolyn were talking about. I think shadow banking is a really important one. And the second aspect, which in a way is higher level, is how do we bring this very huge and powerful banking and financial system, at least into slightly closer alignment with the public interest in terms of our needs economically, socially, environmentally. And I'd say like neither has really been done, especially not the latter. But even the regulation, although it has gone some way, as we heard, increasing capital, it's essentially been about how to let banks fail less badly, in a way like risk management of a system, rather than actually how is this system failing our needs, the public interest. And the lending isn't really different. So as Josh showed, we still have, even in the last couple of years, 10% going to productive lending, 80% to property and financial markets in the UK. And we've seen recently with COVID how ill-equipped the banks in the UK are to serve SMEs, small, medium-sized businesses, despite this, as you all know, being very much a part of the description of what banks do in economic textbooks. So even though the government in the UK has backed loans so that banks have no risk to lend to SMEs, we've seen them on lending at quite significant interest rates, and that hasn't had the effectiveness it's really needed to. And that, there's not a level playing field, I guess, between small businesses and the banks that are meant to serve them. There's also major issues in inequalities in terms of accessing finance and financial inclusion. So in the UK, we see Black and Asian communities experiencing a significant disadvantage in terms of accessing financial institutions and services. And we see that another aspect of financial inclusion is, physical access to bank branches. And we've had a huge program of bank closures in the UK, with closure rates of kind of 60 a month, and basically a third have closed since 2015. There's like 160 closures, and this isn't just about people being able to access their finance, especially if they don't have access to the internet or they don't feel confident in internet banking, etc. There's a lot of different needs when it comes to financial services, but it's also around thinking about local economies and how, if you take out the bank branch, you also take out economic activity, which can affect the high street, etc. So our banks aren't really fit for purpose on lots of different levels. And I'd say that, as well as thinking about money getting pumped into property and financial markets, we also need to see that they haven't really taken any action on climate. So we have two of the worst offenders in Europe and some of the worst offenders in the world based in the UK, so Barclays and HSBC, which since the Paris Agreement have lent Barclays an additional $118 billion to fossil fuels, and HSBC more than 86 billion, which is huge amounts and takes us very far away with where we need to be to have a sustainable economy, and one that meets our climate change needs. So I'm just going to talk a little bit in the last couple of minutes around things that matter. Really agree with what's been said already around regulation of shadow banking and the credit guidance. So we did a report on looking at the fact that we need more alignment between the Bank of England and the Treasury. And actually, if we're thinking kind of systemically around macroeconomic policy, we need alignment of credit allocation if we're serious around an industrial strategy, so as Josh mentioned. So credit guidance is a really important part of that. But there are other things as well. So ownership matters. As I mentioned, we have kind of, even since the crash, we have quite a concentrated banking system still. So most of our banks are shareholder banks, prioritizing the bottom line, but also having often quite toxic culture, which is about big payouts to the top. And what's been disappointing is some of the new challenger banks, if you like Metro Bank and others, have also fallen to that model of really being about the shorter term shareholder profits, bonuses and payouts to the top, and quite often about customer services, but not really kind of thinking about, say, who are they serving, what's their mission, how can they actually think more about delivery to SMEs, for example, or even to thinking about social and environmental missions. So although there has been these new banks that often been kind of competing for the same pool of people, there have, however, been some new banks set up which are exciting. So there's a network of mutual banks being set up across the UK, one in the Southwest, run by someone me and Josh have worked with, Tony Greenham, and they are really thinking about these issues of ownership, of what the mission is, and how they can create banks which have are much more aligned with the kind of public interest. And there's banks like Triodos who have been around for a while but have expanded and offering current accounts and things. So, it does matter what kind of banking ecosystem or infrastructure we have, and the UK is one that's been very concentrated since the kind of 80s when, a lot of the kind of building societies and mutuals shut down, or as Karen said, got absorbed by these bigger banks. And so we do need to do some of that rebuilding. We also will need those kind of national investment banks if we're serious about a Green New Deal and climate. And one of the banks that we've been focusing campaigns on is RBS. So that was bailed out, but also brought into public ownership, and the kind of consecutive Conservative governments have been selling it off. But actually, we've done a lot of work with the public, and polling that we did last year showed that only 1 in 10 people wanted the government to sell it off. And especially now, there's actually, if we had a government that was kind of considering some of these more systemic issues around finance, then it would be a really good time for the government to buy the remaining shares that it doesn't own, and really thinking about realigning it with the needs of the economy that is, not centered on the property markets of the Southeast and the City of London and financial markets. So that's something that we're going to continue to work on. And it's no surprise that the RBS is actually one of the best lenders in the UK on the COVID scheme, because the government can lean on it to lend. So we do need to think about ownership. It is a key area. And I think I'll just finish with the point that, part of the issue in the UK is that we've had this finance sector that's exploded basically in terms of size, and it's actually, it's far too big relative to the kind of the size of the economy, and it's really about serving those global financial markets and not the domestic economy. And I think, we do have this crossroads right now of where we go. We have Brexit, and are we going to see, doubling down on this finance sector, which is quite self-serving and really about asset price inflation and market liquidity and pumping money into those global financial markets? Or are we going to see a shift to thinking about how we can get banking to be aligned with the public interest and better serve the economy and the needs of it? So I'll finish there.
Wow, thank you all. That was a great kind of tour of many issues around the banking system, around credit allocation, around the shadow banking system, around ownership of banks, around kind of where banks invest. And we'll look at those right now for a few minutes in a Q&A. I'm going to invite you all to type any questions you might have on the Q&A. But let's start on a question that's kind of received a lot of attention, and in the UK people love talking about the housing market. So this was for Josh around kind of whether it's really kind of bank credit that leads to increase in house prices. But then another question for me that kind of I'm wondering when you speak about increasing regulation on lending to households, for example, would that end up meaning that only the rich kind of can buy their houses with the money from their parents in the end? And so kind of how do you balance these two things basically? But yeah, Josh, do you want to go ahead and take that one?
Yeah, thanks, Marco. And there's also another sort of related question there on deposits. So I'll try and weave in. So yeah, it's a very good question. I've written a book which sort of explains it in depth if anyone's interested. Why can't you afford a home? But I'll try and sort of keep it brief. Basically, there are, of course, many drivers of house prices. One of them is supply. but there are other issues such as, there's supply and there's demand drivers, essentially, a variety of different drivers, population growth, immigration. But what's been sort of missed, I think, in policy terms, are the demand side drivers, what I would call the speculative demand side drivers. So this shift in essentially seeing housing as a place to live, consumption good in economic terms, which you live in to have a place, shelter, take your kids to school, all the other things you need a house for, to a shift towards seeing housing primarily as a financial asset upon which you can generate either capital gains or rent income if you're a landlord, a buy-to-let landlord. And what you see if you look at the data on this, and I've looked across a number of different advanced economies, is you see the same increase in house prices around the same kind of time, basically in sort of mid-1990s, in countries with completely different sets of other drivers aside from credit. So, countries as different as Australia and Italy, or even to some extent France, for example, and the UK, all with very different planning systems, different supply side dynamics. But you see that same increase in house prices around the same amount of time, and it correlates, almost exactly with increases in mortgage credit. So it's very hard to explain that sort of correlated increase in house prices around in the mid-1990s, other than being caused by expansion in mortgage credit. There's also been a variety of econometric studies, if people are interested, by the IMF, the OECD, which find deregulation of the banking sector to be the most important driver of increased house prices, examining a whole range of supply and demand side drivers. So there's pretty much a consensus around this amongst most what I would call sensible economists. There's obviously some, more supply side oriented economists who claim it is about supply. On your question, Marco, you're right to point to the equity problem here, that if we rein in mortgage lending, does that mean only rich people can own their homes? I think the answer to that question is we've got to create greater tenure neutrality. So at the moment we have a tax system and a sort of set of fiscal policies, as well as a credit system that favours home ownership as the superior form of tenure, both in terms of returns on wealth, in terms of the quality of housing you're likely to have, and a whole range of factors, which means that everyone wants to own a home. There's no reason for that. In Germany, less than 50% of people own their homes. People rent with families for their whole lives in very good quality housing. That it's not really an issue. You can't be thrown out of your house as you can in the UK after 1 year if you're renting. So better tenure rights, better rental rights for renters. There's also, of course, the public housing options, social housing, public housing. In Europe in the 60s, we had a huge range of very high quality public and social housing. That's sort of been residualized as a sector. So we need to think about rebalancing tenure to address that problem that you raised about inequality. There was a question here just on the deposit. Somebody's saying, isn't mortgage lending leveraged off the buyer's deposit? This is Dave Eldavas. Yes, it is, of course, and I think that speaks to the same point, that it's not a very fair system if the richer people who've got a nice deposit from mum and dad are the only people that can afford to buy homes. And again, I think we need to think about having a housing system with more mixed kind of tenure. So I'll probably leave it there. Thanks.
Thanks, Josh. That was great. I'm going to turn to you, Carolyn. I'm wondering, there's one question for you around kind of explaining what collateralized interbank lending is and what a transition away from this would look like. And if you can spend a little bit on that. And then a question for me, which was around the fact that you were saying how banks are better in kind of allocating credit to smaller firms, but what I've mentioned in the introduction, and I don't think we had the time to discuss, was the fact that now after COVID, we've seen a huge increase in debt for businesses, and so would kind of market-based finance be a solution to increase the equity in these businesses, so that there would be less, more investment, more direct investment from funds, for example, into businesses. And would this be a solution to the problem of having too much debt? But yeah, I'll let you take that away. Thanks.
Okay, so those are kind of two big questions. I'll tackle the collateralized interbank lending question first. All right, so back before the 2008 crisis, and even more so before, in the 1990s and earlier, when banks sought to borrow money from each other, there were two core markets. In the US, it was the federal funds market, and then there was the London interbank market that, everybody's probably heard of LIBOR rates. That's an abbreviation for the London interbank market. And I'm sure, other countries also probably had other, I know the US and the UK, so I'm very biased in terms of what I'm going to talk about in terms of focusing on those two countries. So those were borrowing markets where banks could borrow from each other. And essentially, there was no collateral. It's based on essentially trust or an understanding that the bank is well enough regulated that it's not likely to go bankrupt. You're not likely to lose your money. And so there were vast amounts of money lent on these markets, leading up even to the 2008 crisis. Obviously, the 2008 crisis made everybody, including the banks themselves, more worried about how bank resolutions would take place. Maybe you could lose money on these things. And to be honest, it also was an aspect that in the Basel regulations, they encourage. The Basel Accords, which have been used to coordinate bank regulation across the various different countries, they actually give benefits to lending on a collateralized basis. So there's also a regulatory basis, which has also promoted the growth of this collateralized lending. And essentially after 2008, as a practical matter, the unsecured interbank markets, which had been at the core of our financial markets, or at least our banking systems, for in London, it probably a century and a half, 2 centuries, you're talking a really deep, these have been around forever. In London, in the US, it's the federal funds market is probably just, several decades old, possibly going back to, I would guess about the 30s or thereabouts. So these essentially stop being used. There's just very little trade on them. Right. And what trade there is frequently not particularly bank related. It's kind of these peripheral entities using them. And instead, banks are lending to each other on the basis of something called the repurchase agreement market. And so it's all collateralized lending. And I could get into way too much detail on the fact that this particular type of collateralized lending, it's very different from a mortgage. You will notice that, if you have a mortgage and your house price falls, the bank can't come to you and say, you need to put up some other kind of collateral or I'm going to foreclose and take your home. That's not how a mortgage works. When we talk about repurchase agreements, that's actually how they work. So if you're lending against a 30-year treasury and it falls in value, the lender can come to you and say, you need to give me something else as collateral or I'm going to take the treasury. And they can do that in a matter of days. So it's a really, it's a very special form of collateralized lending that I have argued, and many other people argue, particularly Daniela Gabor, has a tendency to rely very heavily on market liquidity. And precisely because there is this kind of instability in market liquidity, it causes huge problems in crises. Right. And so if you're looking at 2008 and Bear Stearns, if you're looking at 2008 and Lehman Brothers, if you're looking at, at what happened in March just now with the COVID crisis, it's really closely tied to collateralized lending. And so it's a profound source of instability. And that's the reason I'd like to move away from it. However, the reason I just kind of put something vague like transition away from it is that it really is deep in the DNA of our system now. We've been doing this for 12 years. And so managing a transition away is difficult. I mean, it's kind of like this little bomb we have sitting in our system, and how do you defuse it? Well, it's going to have to be careful. And that's a very technical, difficult question. And I don't really know how to do it, but I think especially after March, to be honest, there are quite a few people in the central banking world who are sitting here saying, we got to find a way to defuse this bomb. But I'd like to tell you how to transition away from it, but I don't actually have the answer to that question. All right, so let me move on to this next question on the huge increase in debt for businesses that's taken place, and the question of whether, well, I mean, could we use, if I understood correctly, equity finance instead? Like, let's get away from relying so much on financing businesses by debt and focus more on equity finance. And oh yeah, so that's something like the way I did my presentation. I didn't get into those complexities. Yeah, I think investment funds are actually fairly good. If you want to talk about equity finance of businesses, and you want to talk about a mutual fund that invests in, in shares in a business, I think that actually, like, I think that's a good thing. Like, we want to have that kind of investment. It's a good thing. It is very much more when you start talking about investment funds in debt as competition for bank lending that I think we get into a much, much more difficult world where essentially, as the charts that Josh was showing us, when banks started to have to face competition, in particular from money market funds for doing short-term lending to businesses, what actually happened was that the money market funds don't have the same regulations. They have much lower costs. They essentially could lend to businesses at a lower interest rate. But there's this one kind of little trick. They did actually have the big banks that kept growing provide a backup guarantee to the business lending when they were doing the short-term business lending. So that's this off-balance sheet banking that creates shadow banking that I was talking about. But what that actually meant was you have money market funds providing relatively low-cost loans to businesses on a short-term basis, and businesses also need a lot of short-term finance. They do not just need equity finance, they need short-term finance. So that this short-term finance is coming through the money market loans, through the commercial paper market. It's at lower rates. Your small banks can't compete with this. And what your big banks did is say, okay, we'll just provide off-balance sheet guarantees. They already, even in the 70s and 80s, had a too big to fail guarantee from the authorities. People knew the big banks weren't likely to go bankrupt. So they said, okay, we want these guarantees to come from the big banks. Right? So the big banks are providing a backup to this business lending. The small banks can't get their foot in the door, man. Like, the whole system is built against them, right? So essentially, it entrenches the big banks, but it entrenches them in a way that they're providing all of these services on an off-balance sheet basis. And they, as we learned in 2007, it was totally overpriced. Took Citibank down. I mean, that's not officially what it did, but if you look at what was going on, Citibank basically failed in 2007, and essentially this whole system was set up so banks weren't really paying attention properly to the quality of their lending, right? So basically, what I would say is that, yeah, investment funds are good for equity. We need to have our banking system providing services in terms of short-term debt that keeps our businesses operating on a short-term basis. And they really do play a key role in this particular niche, which is what they used to do. And so, there are a lot of details here.
Different roles for different, yeah, definitely. Okay, thanks, Carolyn. That was very clear. Fran, there's been many questions for you. I thought the one on kind of how to favor the growth of kind of mutually owned banks was very interesting, and also a kind of around whether government-owned banks were such a good thing after all, and whether there's examples of where kind of government-owned banks didn't work. But I'll let you answer your favorite, and just, yeah, if you can do it in a short time so we can move on to the economics education.
Okay, I'll try and just take a few that I've seen. I'm not sure that they're the same ones, but yeah, I mean, in terms of the mutual, I mean, I think someone asked a question around how can we ensure it's in line with the public interest. I mean, in terms of a mutual, its ownership structure is going to be kind of one member, one vote. So the members themselves, if you want to become a member, it's, you know, really easy. You just need to open an account or have £1, I think. But I think that they might be trying to kind of establish it with a mission. So I think they, you know, you can't, those things aren't mutually exclusive. You can think about both. Obviously, you know, that isn't going to come from government at the moment. And in terms of a state bank, I mean, I'm sure probably two other panelists have better knowledge on when this has gone wrong. I guess when we look at the Green Investment Bank before it got sold off in the UK, although it didn't have very much power, it can, for example, kind of lend as much as it wanted or lend at anywhere near the rate of a commercial bank. It still, with what it could do, it managed to increase funding into green industries. So it had a very specific mission that was, you know, decided by, can't remember which department it was at the time, I guess DEC. And, you know, so it depends what your state-owned bank is trying to do. And I think especially now when we look at the environmental challenges, you know, it just seems ridiculous that we sold off the Green Investment Bank, and the Conservative government are thinking about bringing it back, which, you know, is probably what they need to do and need to give a lot more powers. But obviously, you know, ownership doesn't mean necessarily the right money going to the right places, which is why I think it is important to talk about mission. What is the purpose? And I think that we too often don't talk about purpose in many things. You know, essentially, finance is like, it should be a utility in the same way that we have water coming out of our taps and electricity. We should have access to finance to be able to make our payments. And, you know, we've kind of allowed it to get into this, you know, the peak 90s when it was seen as this glamorous industry. You know, think about the Wolf of Wall Street movie, quite kind of grotesque levels of wealth. And actually that, it kind of almost shifted in people's mindset to this like, you know, exciting, glamorous industry. And we do need to kind of put it back in its place to an extent. And I think that's someone asked about toxic culture. And I think like to an extent, like that's happened. We still have massive mistrust of the finance sector. We don't like to know, like there's so many scandals that have come out over the last 10 years, but there's a lot of work to do to really, you know, I think banks have to an extent work to shift their leadership because they understand that it's not really acceptable. But there's, you know, there's systemic change that needs to happen if we're serious about aligning it with public purpose that needs to be led, you know, from government, from Bank of England as well.
Right.
There was a green finance question. I guess I was just going to say there is a lot of greenwashing, like for sure in the green bond market, and it's stuff that we've talked about. And I think when I've been on panels and with bankers who work on sustainability, or even with EU kind of commissioners and things, when you say there's loads of greenwashing in the green bond market, that needs to get sorted out. It's really uncomfortable. And I think we need to kind of keep talking about that, because otherwise, you know, green finance is growing fast and we want it to have integrity, and to have that we need scrutiny and be really clear about the fact that there is a lot of greenwashing happening, and regulation needs to catch up with that. Maybe I'll leave it there.
Great, thank you. Thanks all. That was a really interesting discussion. And so, as I said at the beginning, the second part of the session is around looking at how economics textbooks and courses at the moment teach about banks. And so the main model that I've learned and that many of us have learned is around money multiplier, which kind of commercial banks act as intermediaries and they move existing money around the system, whereas actually commercial banks create the money and they have this power to kind of extend loans to borrowers into different sectors. 80% of new money, as we were saying, is kind of lent to either the financial system or housing in the UK today. And so kind of this is not really something that's covered in economics textbooks. And so in November 2019, Rethinking Economics launched this campaign with an open letter calling upon economics professors and teaching staff to not only teach one model, the money multiplier, but to teach about other models that kind of expose this reality better. And we've had quite a lot of take up at the University of Malta, for example. The department has committed to kind of changing its curriculum, as has the University of Amsterdam. And so these successes kind of show us the way, but the questions for you are kind of, what do you think is the impact of teaching undergraduate economics theories that don't represent the actual banking system and the reality of the banking system? And secondly, why do you think there's this kind of reluctance to change how it's taught? Who stands to gain from teaching it as it is right now? And Fran, I know you need to leave in 15 minutes. So if you want to start on that one, that'd be great.
Sure. Can you just repeat the second question?
Yeah. So is there anybody that stands to gain with kind of teaching it like it's taught right now as an intermediary rather than as banks kind of having power to allocate money in the economy?
Yeah, I mean, we've done a lot of thinking about this at Positive Money. Like when we obviously, well, we not obviously, but we worked closely with Josh when he was formerly at the New Economics Foundation and did a lot of work to kind of get the Bank of England thinking. And they did publish this quarterly bulletin in 2014, kind of saying, contrary to most economics textbooks, actually banks create money when they lend. Loans create deposits, not the other way around. And I think when it was still interesting that you then thought, well, you know, surely everyone should just teach this now. Why are they still teaching just the money multiplier? And, you know, I think and obviously the two academics are more qualified to talk about this, but when you've based a whole career on a certain way of thinking, and then obviously there are kind of economists that sit outside of the neoclassical school, which is the dominant school, then it's kind of connected to your identity, I guess, and to suddenly stop teaching one thing and start teaching another is you're going to have had that kind of internal shift. And, you know, it was interesting kind of this, you know, back in the time when Adair Turner and Martin Wolf started talking about this in the Financial Times, and Adair Turner was the head of the FSA, and it was kind of gaining traction. You did see kind of quite high profile people like Olivia Blanchard, who was head of economists at the IMF, I think at the time, like kind of shift from saying that isn't true to then of course it is, and kind of suggesting that he'd known that all along. And I think, you know, I think the key thing is that you don't want people to have to be shamed or something. You need people to kind of want to just make this kind of reflection and shift on their own ability. But yeah, it does kind of obviously it quite often change, you know, as we kind of learn is the hardest thing for humans to do sometimes. And so kind of there will need to be those students pressuring sometimes, because it can also just be inertia. So I don't really think anyone has anything to gain from not changing, but actually there is a big challenge of shifting. And I think obviously I really love Rethinking's work and just want it to grow, because this is quite a specific thing, and I think it's really fundamental. I wasn't trained as an economist, but it does feel to me money and banking is quite a fundamental part of the economy, and one that's been too much ignored by kind of neoclassical economics. But I think it's also quite clear with the challenges we face, we do need economics to be more pluralist and open-minded in a lot of ways, and we need to train economists in that way of thinking. So this is a really good case study for other areas as well. I don't know if I answered both parts.
No, that was great. That was really interesting. I think the psychology of people that you're trying to change, and I think for all social movements, it's like you want to make people feel like they take their decisions themselves, and it's like a big challenge of how you bring about this change. Josh, as you might be teaching these things now, and kind of I'm wondering if you have any thoughts on what Fran just said, and also on the question of whether, the way this is taught right now is part of the issues that you were discussing before.
Yeah. I mean, I think I'd agree with Fran that there's a certain amount of how should we put it, sluggishness in academia generally in terms of changing the content of syllabuses. There's lots of incentives not to, as a lecturer, I can tell you for myself, not to change content once you've got your set of lectures and slides ready and you're familiar with the material. So I mean, there is that issue. I think there's a deeper issue though, which is that we haven't seen. I mean, the sort of theory of loanable funds is in a way just one example of a wider problem of the dominance of neoclassical theory in the way economics is taught in universities, and the insufficient shift we've seen since 2008, despite the brilliant work of Rethinking Economics and various other student movements and the efforts of academics of various types to try and move things along. I think some of this is just sort of to do with brute power. The top, it tends to be the case that it's the top universities which are quite more neoclassical than some of the some of the more heterodox departments tend not to be in the top universities. They tend to control the top journals, which of course tends to create a sort of a self-reproduction of the sort of control over the journals, control over the content of the lectures kind of goes together. So so that's it's a sort of self-fulfilling thing, and so I would sort of say, whilst it's great to kind of isolate this particular issue, and there may be particular idiosyncratic things going on here, there is this broader problem. And the broader problem in a sense is that neoclassical theory has this classical dichotomy between the real economy and the financial economy that Schumpeter made absolutely central to his critique of economics, really way back in the 1920s when he was writing, and Keynes as well made this distinction. As Fran was sort of alluding to, that to make that shift to say that actually the financial economy, influences the real economy or even drives it via credit creation and allocation, does mean ripping up a whole body of thought that goes well beyond just money and banking. It challenges equilibrium theory more generally, and the idea of for example, the concept of a financial cycle clearly challenges the concept of the business cycle, which is essentially short-term disturbances around an equilibrium. The financial cycle appears to be kind of 10 to 16 year cycles, which calls into question whether there is a sort of equilibrium, especially when those cycles are sort of getting bigger and bigger over time. So it's sort of, it sounds like a small thing, why don't you just stop teaching a money multiplier? But really it requires the sort of consequences of doing it leads to much bigger shifts and really changing curriculums much more generally. Having said all that, we have to keep pushing it. We have to keep pushing for this change, and writing letters to departments demanding they teach stuff that is factually accurate is absolutely vital. And then if that doesn't work, you obviously need to take the next step, whatever that may be, to move things along. Yeah.
Thanks, Josh. Karen, do you have any thoughts on any of kind of Fran and Josh's answers, and kind of in your teaching, how do you deal with this issue, and what's your way of approaching the way the banking system works or teaching to undergraduates?
Yeah. Well, I think first I just to add in, and maybe, I mean, it's to encourage you to keep pushing this, but at the same time, like when I look at this from a historical perspective, you can make the argument that, you know, these kind of debates go back to Adam Smith and Henry Thornton, who was a very famous banker who worked on money. Where essentially it's when you want to think about the real economy and have a simple view of the economy, people want to get away from this financial world, right? And so basically the whole concept of what economics does, in a lot of ways, is built on abstracting from the financial, right? And that goes back for a long time. And then you have Schumpeter, who was fighting these battles himself. He was trying to do the same thing you were, and he comes out, I believe it was like in one of his books in like 1939, and says, "We finally won. Everybody will now acknowledge the importance of the banking system," right? And you're like, oh, well, maybe not. So I mean, I think a core problem really is exactly what Josh was saying, that it's just so much easier to think about the economy as something that's real, right? And we can have all of these fancy models and constructs to understand things that are real, but once you throw in the financial, you're essentially taking away the equilibrium. You're taking away our certainty about what's going on and why it's going on. And so it is a very destabilizing process. And for that reason, yeah, I think it's really, it's always going to be an ongoing battle. There are always going to be forces pushing against it to do, right, you know, to stop that. And I have to admit, I think the other thing is that it actually is difficult to teach the material about the banks and the financial system, precisely because you lose a lot of anchors, right? So it's you know, you kind of say, okay, now we have problems with asset price bubbles. Well, guess what? Prices don't mean the same thing in the world with asset price bubbles that they mean in our simple economic models, right? And so we lose so many of the anchors that make economics easy to talk about. I mean, you've got to acknowledge it's hard to teach. And I think, I guess, you know, I end up...
Interrupt you for a second. Fran, I'm wondering, I know you have to go, and I'm wondering if you have any parting thoughts for us before we go back to Carolyn. Sorry.
Really, I mean, I really enjoyed being on this panel, and I think, you know, these are really fundamental issues. I feel like from a civil society perspective, before the crash, there wasn't really civil society pushing for not just kind of campaigns on banking reform, but also the economics education and rethinking. And although, you know, sometimes it does feel like you're looking up at a mountain and you've got a lot of work to do, I think that, you know, this is now much more interesting. If you look at like the young people coming out of university, I think that we do have kind of people on our side, and people are linking. So they're linking the dysfunctional economy with climate change, with Black Lives Matter, and seeing these as systemic problems. And actually, I think the young, you know, I'm very hopeful about the younger generation, but have much more, they are much more comfortable in uncertainty and complexity. And actually, that's exactly what Carolyn was just talking about, is that we don't like to not know. You know, we've kind of come through the Enlightenment and rational thinking, and we like to think that humans can kind of understand these things and have all the answers. But actually, if we're going to get through the next few decades, we're going to have to shift, and, you know, and academic leaders will have to kind of think about shifting as well to how can we kind of be comfortable in complexity, and I think, and in pluralism, right, in terms of economic schools of thoughts. So I do see, you know, everything as being interlinked, and I'm hopeful. And just want to say thank you to everyone for joining from all over the world, and thanks to the great panel, and hope to see you all soon.
Thank you, Fran, and hopefully the people from all over the world will help you in your big expansion of Positive Money.
Oh yeah, and do sign up if you're interested to Positive Money to our mailing list. Take care.
Okay, so sorry, Karen, before I rudely interrupted you, did you want to finish your thoughts? Sorry, you're still mute, I think.
Yeah, sorry. No, I think we can move on. I mean, the conversation keeps going. I think it'll be hard to get back to that.
Okay, sorry. Great. So I'm wondering if there's any questions here. So I think one of the kind of things that often academics respond in these issues is saying kind of, this is just simpler to teach it like this. And then even if the banking system kind of works in another way, it's too complex for undergrads to understand. And this is kind of done in many examples in economics of kind of where a more simplistic model is taught at the beginning. And people are then taught, oh, afterwards you learn the reality, and you might never then be taught the reality. But I'm wondering if you have any thoughts on this kind of critique that it's just a simpler way to do it, and when you kind of when you enter the real world, you learn more, and whether there's like simpler ways to teach about how banks actually work that are not the multiplier model. Yeah. If one of you two kind of has an answer to that one.
Yeah, I mean, I don't really buy that argument at all. I mean, I just don't think it is that complicated, really, to explain money creation, credit creation in a simple way. I mean, I've obviously written a book which tries to explain it in a fairly simple way. I mean, a textbook called Where Does Money Come From, which was specifically designed to help university lecturers rejig their syllabuses. Clearly, it hasn't had the impact I was hoping it would have, otherwise we wouldn't need ongoing campaigns such as the one you've just been talking about, Marco.
But I was very excited when it came out, and I was at university, and it was like, wow, finally.
Yeah, yeah. We need to do another edition probably. It's a bit out of date now, but yeah, I think it's it's not that challenging. I mean, I think you know, some of the things that Carolyn's been talking about with regard to the complexities of repo lending and shadow banking, and financial markets risk. Those sort of things are quite technically challenging, but I think just explaining using a T-chart a bank's assets and its liabilities, and when it makes a loan it expands both its assets and its liability side, and in the process creates a deposit. I mean, that's pretty simple, and in a sense that sort of stuff should be taught to everyone, whether they're doing economics or not, I think, because it's just so vitally important in understanding capitalist economies, and running businesses and all the rest of it. So it's almost a sort of, I would say, something that should be part of some sort of citizenship education, actually, beyond just economics. And of course, if you did that, then when you started teaching nonsense in economics courses, you get some immediate kickback, I expect, from students. So yeah, I don't really buy that. I think I think coming back to your original point, in a way, Marco, there probably is some vested interests in maintaining a status quo that that banks are not as sort of important to the functioning of the macro economy as we're sort of arguing they are, in a sense, because that sort of worldview discourages more regulation and more intervention. Because if your view of banks in the economy is simply as a sort of veil over the real economy, as Schumpeter talked about, just oiling the wheels, as it were, of the real economy, which is the labor and factors of production being mixed up together to create output in real exchange, then then the role of banks just seems less important. So there may be a case of there's these sort of revolving doors between the big banks, and the central banks, Federal Reserves, a lot of people from Goldman Sachs coming in and out. I mean, there may be something in the idea that actually the status quo sort of suits certain certain interests. I mean, sure, it'd be hard to find any kind of concrete evidence of that, but there may be something in that, even if it's quite implicit and informal and tacit. So yeah.
Yeah, I think can I add a little bit? Yeah. So yeah. So I mean, I think there's also an underlying issue in terms of thinking about this. I mean, the way I understand the kind of the evolution of how we got to where we are is that it's precisely the fact that we didn't understand the banking system, that we have this emphasis, and I'm talking about like policymakers, highest level economists, you know, most of the people who teach at the top schools, especially in the 80s, the 90s, 2000s. I mean, now they're opening their minds, but certainly for many years, this didn't even enter the framework, right, of the policymakers, of top economists, of top lawyers who were writing the laws, right? It wasn't seen, right? And I think in a lot of ways, you can make the argument that when we had a world that was built on kind of an implicit understanding of these ideas, I'd say in the 1930s. So the reforms of the 1930s actually were very clearly founded by people who had a good understanding of the role played by banks, right? And I'm not talking about the US right now, like the US financial reforms of the 1930s that put in a particular structure, right? And at some level, it was because that good regulatory structure existed that you could get away with ignoring it. Right? It was all, the regulation was there. The banks were doing what they were supposed to do. We had this foundation that allowed us to think about the economy as having liquidity and floating smoothly. And you didn't need to worry about market liquidity because actually the banks underlying it were providing it because they were well regulated. But then in that world, we ended up developing a bunch of academics and policymakers who decided it wasn't important. Like they thought that, you know, markets provide their own liquidity, the banks aren't important. They moved into a different intellectual framework than we had been in the 1930s. And I think there's a really strong argument that it is essentially because the top policymakers had no understanding of these ideas in the 1980s, the 1930s, early 2000s, that we're watching our economy have these kind of absolutely dramatic crises. You know, don't believe anyone when they say there are always crises this big. It's not true. like the crises we're having of the size of the 2007, 2008, the huge crisis in March 2019 with the Fed jumping in there to do like utterly unprecedented, off the charts actions. These are created by a failure to understand the banking system. Like, so to me, like the reason, you know, and so for me, this is like, there's a real driving force that it's not just you need to teach it to undergraduates, you got to teach it to the professors who are teaching at Harvard. So I mean, and you know, I mean, so that's kind of one of the battles I fight. I don't think we understand banking history. Like, you know, we don't even understand what happened in Britain in 1800 because we haven't studied the banks properly because we're not using the right frameworks. So anyhow, I have strong opinions.
Yeah, that's fascinating. Yeah. So one more question that's coming here from an anonymous attendee is about the fact that kind of a lot of non-neoclassical economists want to give primacy to production in the real economy over finance and are highly critical of theories of how fictitious capital runs ahead and influences the real economy. And the person's wondering whether you can say more about that.
Yeah, I can have a go at that one. I mean, I've been involved in some of these debates around whether Marx really understood money or not, and I think you can read him in different ways around that point. But I think it kind of goes back to the slides I put up at the beginning of my talk. Really, is that and as Carolyn was I think implying as well, that, you know, finance, you know, can be a force for good. It can fund productive activity, and actually it's actually more than that. it's vital for innovation and entrepreneurship, because essentially it allows new firms to enter the sort of circular flow that the mainstream sort of talks about. New money creation, giving a loan to a small firm, allows it to compete and draw on resources in the economy that it would not be able to do if we had a finite amount of money just circulating around and around, unless some firm just decided to lend it to them, which, big firms tend not to just help out people to create new competitors for themselves. So it has this vital function in terms of innovation, in terms of competition in the economy. But what we've seen, I think, is the gradual development, the idea that financial markets can self-regulate, that they can be left, in a sense, to, if we leave them alone, that they will optimize and become more and more efficient over time. And you have this concept of deep financial markets. Big financial markets are better, more finance is good. But all the evidence suggests that that's not the case when the banking system shifts in what it actually does towards lending against existing assets, or creating increasingly complex financial instruments, and all of the liquidity challenges that we've heard about. So yeah.
Okay, super. Thanks, Josh. That was very clear, I thought. Okay, so we've got 3 minutes left. This was a really fascinating discussion, and I've really enjoyed kind of being part of that with you, and I think I've learned a lot. If you want to follow Josh more, I think he's got 3 books out: the one on money creation, the one on why you can't afford to buy a house, and then another one that I also really enjoyed about the role of land and credit in the economy. And then Fran, as she said, kind of is doing the international expansion of positing money. And Carolyn, you have a blog called Synthetic Assets, is that right? And people can follow you on that. And then if you want to get involved in the Rethinking Economics campaign to change how we speak about banks and pressure your department to also do that, email campaigns at rethinkeconomics.org, or post in the chat, and then we can provide you a campaign pack and a template letter to send to your department, and then you can kind of conduct this campaign yourself. But yeah, so I found this discussion super interesting about the role the banking system has, and the way the economics education at the moment does not represent this accurately, and how this actually might mean that policymakers, as Karen was saying, don't understand the issues, and so let these crises happen, and don't harness the power of the banking system for this innovation that just talked about. I'm wondering if Josh or Karen, you have any parting thoughts before we close?
Well, just to say thank you, Marco, and to Rethinking Economics. I mean, I've done a number of sort of talks for Rethinking, and you're one of my favorite organizations in the whole world. It's absolutely vital that students keep applying pressure. In a sense, you are the future of economics and of money and banking. So yeah, keep up the good work, and thank you.
Thanks. Karen?
I want to say, yeah, thank you too. This is the first time I've participated in a Rethinking Economics panel, but I've certainly enjoyed it and learned a lot. And I think, yeah, I mean, absolutely, your agenda is necessary. I mean, I'm so happy there are people who are lobbying for these views, because we need to change economics, and I think we need to do it in order to have financial stability and a functioning economic system. So to me, I think these are absolutely foundational, and yeah, keep doing the good work. Thank you very much.
Thank you all so much. And the recording is available, will be available both on the website, and is available right now on Facebook. So you can kind of look at the slides as well. And so yeah, thanks again to all our panelists and to all of you for coming. We had 160 people in this session, which I thought was really great. Yeah, have a good day. Thanks.
Thank you.
Thank you.